Let's now quickly revise the topic of internal reconstruction, which is chapter 14 of your syllabus. A company will go through internal reconstruction when it is on the verge of being liquidated. The assets are overvalued, the payments are due, the liabilities are not paid on time, expenses have also been not been paid, creditors have stopped supplying the goods, debtors have stopped paying the money, and the company has huge accumulated losses, and net worth is also negative. Only option in front of the company is liquidation. In that point of time, if they want to revive themselves, the option that's available is internal reconstruction. Like I mentioned, the situation has huge accumulated losses, overvalued assets, overdue payments, unsettled liabilities. The process is they will reconstruct themselves by revaluing the assets, bringing them to the most realistic value, restating the liabilities by actually negotiating with the debenture holders, creditors, and people to whom they owe money. They will negotiate and ask them to decrease the liability to the extent possible. And we'll reorganize the capital. We'll reduce the capital if possible, subdivide the shares or consolidate the shares, convert them to stock, whatever is best possible. We are basically doing a major surgery inside to revive the company's balance sheet and make it look much cleaner with assets at presentable value, that is reduced value, liabilities at settlable value, write off the liabilities to the extent possible. And in this process, we take one big bandli with us or big bucket with us wherever we go to pick. That is called capital reduction. Ma, please give something. Shareholders will put something, and then asset we whatever that we accumulate, no, debentures will put something, creditors will put something. That pegged fund credit whatever is there will be used to write off the overvalued assets, accumulated losses, and if there is still something left, that will be capital profit, capital reserve. And this entire process is very closely monitored by three important sections of Companies Act. Section 48, which talks about variation of rights. Section 61, which talks about alteration of share capital. Section 66, which talks about reduction of share capital. Variation of rights, to start with, talks about changing the rights of the shareholder without changing the share capital. For example, the best example or the most logical and practically done example in the class is changing the dividend rate of preference shareholders. There are preference shareholders to whom you have not paid 3 years of dividend, arrears of preference dividend 10%, but you don't have money to pay. What do? You request them, Anna, please write off that 3 years of arrears of preference dividend. Why? If that dividend outstanding goes on for longer, your business is affected. That's a liability in the balance sheet. You'll ask them to write off. But we need to give them something, no? We'll tell, from now I'll make more profit, I'll give it to you. So I will change your 10% preference share capital to 15% preference share capital. Meaning you will now have 15% dividend. I'll convert your normal preference shares to convertible preference shares if you want. I'll convert your preference shares to cumulative or participating preference shares. I'm variating the rights which is there with those shareholders, and that's variation of rights. And this is done in order to strike a deal in reorganizing the capital. This is what Companies Act section 48 talks about. There is reorganization with regard to voting rights also. With regard to a shareholder, you can give them extra voting right, or we can reduce the voting rate of a specific shareholder. But that's not a transaction. For that, there would be no journal entry. But the journal entry what we pass for variation of rights under section 48 is preference shareholders dividend rate being changed. The next section of Companies Act what we need to learn about is section 61 of Companies Act. Here again, there is no reduction in share capital. There is no decrease in share capital. Share capital will remain the same, but we are altering the share capital. What are we doing? Very good. Alteration of share capital can be done under 4 types. Number 1, subdivision. Number 2, consolidation. Number 3, conversion of shares into stock. Number 4, conversion of stock into shares. We'll discuss one at a time. To begin with, subdivision, which is also called as splitting. Under splitting, we split one share of higher value or higher denomination into shares of lower denomination. Let's say we have one share of rupees 100. The company wants to divide one share of 100 into 10 shares of rupees 10. It's like 100 rupees note being exchanged for 10 notes of 10 rupees. Do you guys get this? So this is called subdivision or splitting of share. Share of a higher denomination is divided into more number of shares of smaller denomination. This the company does so that it will help them in reorganizing later. They can opt for share surrender later or any of that thing. So this is what we mean when we say subdivision or splitting. Remember, in this there is no decrease in share capital. The company had 1,000 shares of 10 each, 10,000 rupees. Now it is converting it into 10,000 shares, sorry, 1,000 shares of 10 each, 10,000. It is dividing it into 1 share into 10 if they divide. It will become how much? 10,000 shares of rupees, 1 each, 10,000. 1,000 shares of 10 each, 10,000 is now divided. 1,000 shares. Each share is divided into 10 shares. It will become 10,000 shares of rupees 1 each, 10,000. Share capital before subdivision 10,000. Share capital after subdivision 10,000. Number of shares before subdivision 1,000. Number of shares after subdivision 10,000. Nominal value per share before subdivision 10. Nominal value after subdivision 1. So number of shares will become more, nominal value per share will become less. Multiply ಮಾಡಿದ್ರೆ product amount will remain same. That is subdivision. Next we have consolidation. This is opposite of subdivision. In subdivision, one share will become many small shares. In consolidation, many small shares will become one share. Let's say the company has 1,000 shares of 10 each coming to 10,000. Company will convert those 1,000 shares of 10 each, 10,000 to, let's say, 10,000 shares of rupees 1 each. Sorry, one share of rupees 10,000 each. Are you getting it? So number of shares will be merged together to make one. So let's say 10 shares will become one share. There are 10 shares of rupees 10 each. Company will convert 10 shares of rupees 10 each into one share of rupees 100 each. That is consolidation. Company might want to eliminate small shareholders who doesn't want to be taking risk. They want lesser number of people on the board to take a very risky decision. So in that case, company can go to consolidation. Again, in this case, pre-consolidation, post-consolidation, share capital amount remains same. Just that pre-consolidation number of shares were many. Post-consolidation number of shares will become less. Pre-consolidation per share value was small. Post-consolidation number of shares value will, sorry, per share value will become more. Multiplicand, whatever you get product amount, that will stay same. Next one is conversion of shares into stock. Whenever we talk about share capital, it will have fraction and denomination. Meaning 10,000 shares of rupees 10 each. 10 each is denomination. 10,000 shares is fraction. So 10,000 shares into 10, 1 lakh. The company wants only 1 lakh. It doesn't want that fraction of 10,000 shares. It doesn't want the denomination of rupees 10. So it will convert 10,000 shares of rupees 10 each, rupees 1 lakh share capital into share stock of 1 lakh. There is no number of shares, there is no denomination. This is conversion of shares into stock. The company, when it has not decided what way to subdivide or what way to consolidate, it has not taken the decision, but it want to freeze the trade in the market. It will convert shares into stock. Later it can decide what denomination it wants, what fraction it wants. Then it can convert the stock to shares. Stock is rupees 1 lakh. There is no number of shares, there is no per unit value. Then they can later decide 1 lakh rupees divided to be divided into 10,000 shares of 10 each, or 1,000 shares of 100 each, or what do you say, 10 shares of 10,000 each. That's up to them. That is conversion of stock into shares. And during this entire process, like I mentioned, the share capital will remain same. It will not reduce. In alteration as well as what to say, variation in rights, the share capital doesn't change. And to do this, company must have power in articles of association, and it should also pass an ordinary resolution in its general meeting. And the last section of Companies Act 2013 relevant for our internal reconstruction is section 66. This section comes because as per the provisions of the act, the company's capital should never reduce. That is the reason we create CRR whenever we do buyback or redemption of preference shares. In this chapter, we are reducing the capital. It should be within the purview of Companies Act 2013. So section 66 says that reduction can happen in two ways. There is more than two ways, but they are not practical, very theoretical, and practically also not viable. Exam also it's not there. So we'll do only two. Number one, reduction only in paid up value. Number two, reduction in nominal value as well as paid up value. What do you mean by reduction only in paid up value? The company has shares of rupees 10 each. They are going to reduce shares of rupees 10 each fully paid up to shares of rupees 10 each, rupees 8 paid up. So nominal value of the share remains 10. paid up value is reduced from 10 to 8. This is reduction only in paid up value. When they do this, journal entry will be share capital debit to capital reduction 2 rupees. We'll write the entry only for reduction. Why does the company do this? Later, when the company wants cash, company can make that partly paid up share fully paid up by making the share call and collecting cash from the shareholder. However, the company can choose to reduce not just the paid up value but also nominal value. Why would the company do this? The company would do this to reduce the or free up the capital within the authorized limits so that it can give shares to somebody. Even if a 10 rupee share fully paid up has been reduced from 10 rupee share fully paid up to 10 rupee share rupees 8 paid up, authorized capital limit is met andre they cannot make further issue of shares to debenture holder or creditor for settling liability. In this case, what the company does is shares of rupees 10 each fully paid up will be reduced to shares of rupees 8 each fully paid up. Here we are not just reducing the paid up value, we are reducing the nominal value also. The beauty of this case is that 2 rupees need not be called from the same shareholder. We can issue a fresh share to another person for cash or to settle a liability. This is what we mean when we say reduction in nominal value as well as paid up value. Instead of going for reduction or alteration, company has an option to go for share surrender. Share surrender is a case where you go to the existing shareholder and ask him to give some shares to the company. Donate. A shareholder has 10 shares. You will ask him, please give 2 shares of yours. When you take 2 shares from that shareholder, share capital is decreasing. Debit share capital account, credit share surrender. Share surrender is a dummy account. And these shares surrendered will stay there. They can be kept in the equity form in which you took the surrender, or you can convert them to preference shares. If you do conversion of the surrendered equity shares to preference shares, there will be no journal entry. Later, you can use this share surrendered to settle. You can give this to debenture holders. You can give this to creditors. Let's say I have some shares surrendered from my equity shareholders. I wrote the entry equity share capital to share surrendered. After this, I am asking my creditors to be taking these surrendered shares and settle their liability. When I settle, debit your creditors account because it is decreasing. Don't credit share surrendered or equity share capital. Credit capital reduction and close that creditors account. I repeat, share surrendered entry, share capital to share surrendered. When the creditors are settled by share surrendered, write the entry creditors account debit to capital reduction. Close the creditors account. And out of the share surrender, will give shares to creditors. There the entry will be ulta of what you wrote when you got the share surrendered. When you got the share surrendered, share capital to share surrender. When you issue these to somebody, share surrendered to share capital. That credit share capital can be equity or preference. Understood? So when surrendered shares are given against liability, that liability should be first transferred to capital reduction, and share surrender entry share capital to share surrender, issuing from that surrender entry share surrender to share capital. If there is any balance in share surrender account at the end, let's say you took surrender of 10,000 rupees worth shares, you issued only 8,000. 2,000 balance in share surrender should be closed by transfer to capital reduction account. And throughout any profit, any loss, any expense, any income, any change in the value of asset, any change in the value of liability, settlement difference, everything will be routed not to P&L but to one account called capital reduction account. And in the capital reduction account, whatever balance is there after all of this and after transferring share surrender also will be utilized to bring the assets to realistic value. If the asset is overvalued, we will write off that overvalued portion to bring it down using capital reduction. We use this to write off accumulated losses, P&L debit balance, preliminary expenses, share issue expenses, or any other expenses which is there which is not written off. We'll use it to write off. After all of this, if still some part of capital reduction is pending, it will be transferred to capital reserve. We can use this to write off intangible assets which don't exist anymore. Patents, goodwill was there when the company is good. Now the company is not good, it's not required. No, we can write off overvalued assets, intangible assets, accumulated losses, and excess will be transferred to capital reserve. And once you do all of this and then prepare the balance sheet, in the balance sheet for the next 5 years, whenever you prepare balance sheet, in the name you should write unreduced as on followed by the year date, just to make the user understand that this company has gone through the process of reconstruction. However, court can tell you don't have to write. But whenever you seek the permission of the court usually asks you to include these statements. Understood? That's internal reconstruction.